Today we're joined by Chris Gillings, founder of Cut Through Venture, talking about their just released State of Australian Startup Funding 2025 report. Chris is also part of the venture capital team with 5V Capital, investing in high-growth Australian and New Zealand software startups that power business. Joining Chris is Albert Belinko, a partner of Folklore Ventures. Prior to joining Folklore, Albert spent the last 10 years as a general partner of Titanium, which was formerly Telstra Ventures, and Folklore's an early-stage investor, often investing the first check. There's a lot for founders and investors to take away from this report, so let's get into it. Chris and Albert, really great to have you to unpack this report. How are you doing?
We are well. I am well.
I think this is report number 5. You pretty well kicked off in the beginning of COVID, and we obviously had that short-term spike, but it's been somewhat down, most reports for the last few years. But I get a sense that this report, things are on the up and up.
Yeah, look, we started at a very opportune time. It was party central in Ventureland, and one of the ironic things about that is the report has aged. That 2021 report has aged very, very poorly. We feature a lot of quotes from different investors throughout the ecosystem, and I think everyone was pretty oblivious to what was around the corner, which was obviously a very tough couple of years in venture world. But yeah, look, last year, as I think it was well documented, everyone was saying we had cautious optimism. I don't think those words were used in this year's report. Everyone's feeling a lot better, and clearly the headline numbers are really good. But generally, in terms of the investors that we gathered feedback from and the founders as well, everyone's feeling pretty buoyant about how things are tracking.
Yeah, I agree. I mean, with $5.1 billion invested last year, which was actually up 24% year on year, it's really the first time in a while that we have stability and growth. And I think that's a positive sign for the market. Undoubtedly, there is a higher bar for investments to be made by venture capitalists. And just like in public markets, where investors are really trying to discern between who is an AI winner and who is not, there's a real focus of that capital in several mega deals that companies perceive to be AI winners. So we're seeing a real focus on that, and we can talk through some of the other key takeouts. But really, where companies land around AI and whether it will be a long-term catalyst for them is one of the key questions.
I'm keen to dive into some of that data, but before we do, one thing that was quite different this time was in your data collection and the use of like the AI interview in your process. Can you talk us through that? Like, what was the thinking behind it, and what insights did you gain from that?
Yeah, we've evolved a lot since the 2021 report, where it was essentially just the Folklore team and myself speaking over Zoom. I was still in New York, and they were, I don't think, even in their office in Redfern yet. We basically wrote the report. We did ask for a couple of quotes, and there were a sprinkling of quotes through that report, but it was really, our takeaways from the data, as opposed to really layering in the qualitative feedback from the ecosystem. And so we've evolved over time. We do a lot of surveys now. Last year we did 20 interviews, which were just Zoom calls with VCs, and recorded those interviews. And I guess that was our, the being able to transcribe phone calls was really the unlock there. You could then have a corpus of information off the back of those calls. So it was really interesting. This year we used a AI interviewing tool. So it was just like an interview process with a human. It was interactive. And it allowed us to interview 115 people as part of our data collection process. So that then gave us this huge corpus of information from VCs, accelerators, venture debt providers, Indigenous founders, to really create a huge amount of information that we could then draw from in our analysis. So it was a huge unlock. It actually made the drafting a lot easier because we did have all of these perspectives that obviously they didn't all necessarily agree with each other. They certainly didn't necessarily reflect all of the views that myself and the Folklore team had, but it was very valuable in terms of being able to get a more realistic full circle picture of the vibe on the ground and what people are saying across the whole venture landscape.
Yeah, I was on a bus traveling from Perth to Margaret River with Judy from Ephemia. She did her interview in the back of the bus, and I did mine in the lobby of a hotel. And the
It just meant that we could squeeze it in rather than actually having to try and get it into the calendar. So I think if nothing else, these tools are more flexible for people and you end up with more results that are hopefully better.
Yeah, look, hundreds of pages of transcripts. So, and then obviously lots of tools at our disposal to sort of synthesize those, and then spend time as a team actually focusing on what are the key takeaways as opposed to trying to ideate around like what everyone else is thinking. We got to gather that information. So yeah, glad you got to do it at your convenience, Don. That was the major goal, but it was also super valuable from our perspective.
I'm going to get my agent to talk to your agent as the next step.
Yeah, exactly. The ultimate goal here is for none of us to have to do anything, but that's next year.
And feel good about it, because some of us don't do anything, but we feel guilty.
Yeah,
Whereas
I'm no guilty, don't worry.
So, yeah, for one of the things that sticks out for me, for founders to really understand, is that there's really data to support the fact that there's a fast lane and a slow lane emerging. And some founders are finding themselves in the slow lane and they think they should be in the fast lane. What has stood out in the data this time around, and what's your advice to people that might be struggling to complete their raise? Because there's more founders that seem to be sure they're going to raise than actually are raising.
Yeah, so we saw some mega deals announced in the last year, and they were specifically around the industrialization and verticalization of AI. And so companies like Thermos raising 830 million. And, very gobsmackingly, they actually almost doubled their valuation with, from what I understand, very little change in the fundamentals during the two parts of that raise. And then meanwhile, Heidi, which has seen really strong traction, they raised an almost $100 million Series B as well. So certainly the companies that are at the forefront of AI, they're doing something that's needed in the ecosystem, or they're applying a solution like a medical scribe that you couldn't have done before AI. They're certainly seeing really, really strong interest. So that's very clear. I think founders and investors are also grappling with the question of defensibility, and I'm seeing that a lot in the conversation that I'm having. So with more Gen AI tools, you're seeing companies that do get traction suddenly find themselves with 20 competitors much more quickly than they used to. And so I think a outcome of that is more deep tech investing. And so we saw that quite a lot in Australia last year. We at Folklore actually really love what we call unsexy and hard problems. So we're no stranger to this area. And a couple of examples that stood out were InfraVision raising almost 100 million USD. Samsara Eco, they announced a monster 20% offtake agreement with Lululemon, which is really a breakthrough in their enzymatic recycling process. And then we at Folklore invested in the $16 million Series A of Hullbot, which make autonomous drones to clean the hulls of ships. So we're seeing lots of interest around AI infrastructure, software, and then also companies that are just very difficult to replicate. And I think a combination of all of those factors is, for a founder, the takeaway is how are you different? How are you different from something that's easy to spin up with Gemini and OpenAI? And then one other striking development, in my view, was the continued lack of liquidity in the market and the growing appetite for secondary. So we can see in the market there's few IPOs, little M&A, still pretty muted in the M&A market. And so we really have seen secondaries emerge as a critical pressure valve for the ecosystem. One data point that's in the report is that 33% of investors now view secondary as their most likely exit route, which is up really materially. So, we're seeing secondaries actually become a sophisticated cap table management tool.
Yeah, look, I think that the dual track, I think what Albert's probably alluding to there, it's actually affecting both startups and funds. It's very challenging for companies that don't have a authentic AI narratives to raise. Or if they do, they're doing it at in some cases, what they would consider a punitive price, even if they are a business that may have, before this most recent wave, been able to raise at a more compelling valuation. If they haven't figured out how they're going to modernize and stay relevant and take advantage of this new layer of technology, then investors just aren't interested, to be crass. And I think like Albert is speaking the tribe love language in terms of these Ori businesses with a hardware component. I think even for 5V, we've always been B2B software specialists. We've spent far more time meeting with companies that do have real world elements to them, whether that's hardware or a services business, but only where they are applying AI to either provide services with margins that look more like software, or to where the in the case of hardware, that the hardware is like is deeply benefiting from utilizing AI. And so, I mean, we at 5V didn't fund any deals this year where the companies didn't have an AI component to their story. But I think you'll see in the data, we did a deep dive into, I guess, the next level of detail beyond sectors. And the sector taxonomy is sort of limited in that companies will always fall into multiple sectors. But when you did a deep dive and we used AI tools at our disposal to scan company websites to see whether or not they actually had an AI product on the shelf, and then looked at where they sat in that AI stack at the application layer all the way down to the infrastructure layer. And when you looked at the $5 billion or $5.1 billion under that lens, it was actually $3.1 billion went to companies that did have a real AI story attached to them. So more than half. And those range from companies that maybe started very recently, but also applied to companies that have been around for several years and have started to either completely disrupt themselves or create new modules or new product lines that do utilize this new tech, not just to opine or make investors happy, but actually generate more value for their customer base and be able to generate more value for themselves by doing so.
Yeah, and Chris, none of that is really surprising when you look at the US market. So you see companies like Chegg, where their Q&A homework help business model was just disrupted by the advent of ChatGPT. And then you see others where, companies like Replit, where adding LLMs has been a astronomical catalyst for growth, and the revenues have skyrocketed since they added those features. So that's in the US. In the public markets, we've obviously seen in the US a massive compression of SaaS multiples. So you can buy companies like GitLab and Atlassian at 5 times ARR today. And the market is really trying to work out who is going to benefit long-term from these trends. So GitLab is used by Anthropic, so maybe they're a bit beneficiary, but who knows? So we see that at the public market, we see it in the US, so it's not surprising that Australian investors are also applying that lens.
Yeah.
I also
Good
think,
point.
oh, sorry, you go, Aaron.
No, you go, Jack.
No, you go, Jack.
Yeah. I also think tying it back to the fast and slow lane is, for any founders listening that feel like they are in the slow lane, AI has actually given you an opportunity to re-accelerate growth. And I think, as Chris has demonstrated shipping the report, like, there is no excuses why you can't embed this in your workflow and hopefully produce and increase productivity.
The framework I've started to think about, Jack, on that front is your ability to experiment as well. So the cost of running experiments for a startup with maybe a very small budget has dramatically fallen due to these new tools. It's not just that, yes, you can improve or automate your workflows. You're actually able to do a lot more, like from an engineering perspective, from a marketing perspective. Basically, every part of your business, you can do a lot more with very quickly and very cheaply, which allows you to take more bets. And ultimately, a lot of those bets won't come off, but they're bets that you wouldn't have otherwise been able to make. And that's just a sort of a framework of thinking about, like, how does it apply? Yes, you hope that your engineering team is taking advantage of Claude Code or Codex, but I think also from a CEO or founder perspective, on the non-technical side, it should be, all right, well, if we were going to go down one path without experimenting on what the correct path may be, a lot of these tools, whether it's marketing or whether it's actually rolling out a new feature, allow you to do that for super cheap. And so we're seeing that in businesses that, yes, they are trying to roll out AI modules, but really where they're getting the leverage is to be able to experiment, be able to do more with smaller teams or without having to grow their teams. And I think it's super exciting. And the board meetings are getting more exciting because you're actually getting to see results from experiments that are being run internally. And that was previously really, luxury only given to much larger companies with big innovation budgets. And so I think it's great.
Yeah. A great example in our portfolio at Folklore is Sphere. So they just raised a 21 mil Series A round with Andreessen Horowitz investing. And I think it's their first investment in Australia. And they experimented heavily and ended up using LLMs to solve the really difficult and annoying problem of indirect tax calculation when you're selling globally. And so that's a really great example of how they directly observed that problem in a prior business incarnation and then realized, hey, AI actually is the catalyst. And they've seen very strong traction since. So I would certainly encourage founders out there to be honest with themselves around, is the business I set out to solve 5 years ago to create, is that what the market really wants now? Or is there some learning in how I've experimented that creates a completely new direction where the problem and the solution is a lot more compelling today?
I think a lot of this attribution of the two lanes and the two different speeds of raising and everything else to AI makes sense. But was there anything in the data other than AI that's also driving that two-lane bifurcation?
Look, as I sort of mentioned, I think it clearly is applying for funds. My back of the envelope math says that there's a lot fewer VC funds active in the market in Australia today than there were 2 years ago. It's incredibly hard for almost all VC funds globally to raise capital at the moment. Clearly, there have been a number of big funds and smaller funds that have done so successfully. But overwhelmingly, our survey data showed that it is very hard going for particularly funds that don't have a long track record or maybe haven't had time for their first fund or their investment history to bake to raise funds. And I think one of the things that I think ultimately the major driver of that is the lack of liquidity that the asset class has shown globally. And the data is even more extreme in the US, where if you look at a chart, I think Carter put out some really good charts on this, the number of funds that it raised last year in the US, it just looked like a true fell off a cliff. And now I don't think it's that extreme here, but we're working off a smaller base. So any decline in what is a very nascent industry that we want to be growing is not great. And so I think there is a two-speed economy in terms of funds that can go out and raise capital. They've either got a really great long history or have tapped into a unique LP base, or they have a differentiated offering like the Tribe team. But for everyone else, it's hard going. It's very hard going. And I think until we start to see not just secondary sell downs, but like some large traditional exits that really flush cash through the ecosystem and show LPs what true venture outcomes look like, I think it's going to remain pretty tricky.
Yeah. I think one of the benefits of secondaries is it actually shows the LPs that the marks are real as well. So like, let's say you sold 5 or 10% of your, one of your marquee assets in a secondary, and you get a great price for it. And it really shows that the carrying value that you have is actually conservative. Yeah. I mean, to me, that's a very strong data point. It's LPs looking at future funds. But I do agree, it's brutal out there. And I think some of the feedback you sometimes hear, both in the US, everywhere really in VC, is LPs want their money back from prior vintages before committing to another fund.
Yeah, we certainly feel that as an emerging manager. Now, one of the things is clear in the report is there's a lot more international investment. You mentioned before Andreessen Horowitz in that firm that you're in. Does the data show Aussie founders going over to find them, and it just so happens they're pulling that money internationally, or are the funds actually here and they're on the ground finding companies? And if they are there any things popping up the way Aussie founders can be more attractive to the international money that's coming?
Look, I think both. So what you see in the data is that there is a real uptick of international participation as you get later and later and later. And that really kicks in at any Series A deal that's over $10 billion, you're almost definitely going to have an international investor involved or a non-traditional Australian VC. So why is that? There's only a handful of funds, literally a hand, maybe like a four-fingered hand, that can write very large checks of over $10 million into a company that's raising a Series A. With 5V, we invest in Series A. Our sweet spot's like $4 to $6 million. We can stretch up to $8. But if we need to go bigger than that, we announced a deal today, or late last week, an investment in Checkbox and led by a US fund. They have us and they have Tidal, but we're supporting that round because our fund size is just not big enough. And of the 4 funds that can really write checks of that size, they decided to look offshore, which I guess ties to that. The second part of your question is like, what was appealing about Checkbox that attracted, a tier 1 investor? What was appealing about Sphere that attracted Andreessen? I think, first of all, my perspective is that you need to be building a business that's either already in the US or has a substantial footprint globally. I think it would be so far to say, like, there's a cynical take, which is like, if you're an Australian investor that's doing really well in Australia, and you meet a US investor and they'll just say, oh, that's cute. That's cute. That $10 million is cute, but that's in Australia. Welcome to the NFL. Come over here and see how you go. I don't think it's that bad, but I do think you need to, as a founder, probably found some progress in the market that you want to raise in. I do think I've come to the conclusion that if you are looking to raise a substantial amount of capital out of the US, but also grow, like refocus your business around the US market, one of the founders being in the market is super important, both from an execution standpoint, but also attracting capital. So it is, proof points in the market that you're trying to raise from, super important, and dedication to the market. Like, I don't think many investors are going to just want to throw money at an Australian company where, the founders aren't even dedicated enough to spread their wings and move countries. The one sort of counterpoint to all of that is I chatted earlier in the year, earlier in 2025, with a number of international investors as part of a webinar that we did. And one of the interesting things who was it? One of the investors said, listen, I asked them about an investment they made in Australia, and they said, listen, we don't wake up in the morning looking, like, we don't scour the Aussie market for opportunities. It's not we don't have anyone that's like looking for opportunities in Australia. We invested in that business because we came across it as, like, we were looking at a market. We had a thesis. We scanned the world to try and find what we believe to be the best-in-class asset under that thesis. And so we approached them, and that's how the investment happened. It wasn't because it was an Australian company, but I do think that clearly there are some VC funds from overseas floating around down here and spending more time down here, which I think is great. But I think ultimately they're looking at a lot of them are looking at the whole world, and are going to seek out the best opportunities globally, regardless of where they are.
Yeah, and they'll sometimes get excited where you're an Australian company, but you've created such a compelling product that you can actually serve some of their portfolio companies, for example, who can be really discerning and innovative buyers of technology. So if you've managed to create a product that one of the hottest startups in the US that is well funded by the tier 1 US VCs, I think that's a surefire way to suddenly get inbounded as a founder. But yeah, we have seen quite a lot of movement in terms of which funds are physically active. And I mean, Andreessen, as an example, I mean, they pulled out of the UK market, and so I'd say there's less physical presence in Australia, but the world is, we're only a Zoom call away. So there is interest when there's a reason for a VC overseas to really believe something's really differentiated and breaking out.
Yeah, it's interesting that the markets we operate in, being Australia, US, UK, but even in the UK, last year there were reports of much more capital flowing out of the US, even into a big market like the UK. So I don't think Australia is alone in that. And Chris, totally agree with all your points there around the proof points that Aussie companies need to still demonstrate value. And I think the other thing we're seeing more, it really speaks to our kind of investment thesis, but reports like you generate and CB Insights and others are just demonstrating how capital efficient our market is, how undervalued our companies are. And I think that's now starting to be recognized on a global stage too. But your report highlighted a couple of those points. Could you just speak to them as well, like comparison to international valuations and what you're seeing as a trend there?
Yeah, so we don't have like great data on valuations, but we do some surveys as it relates to where investors are sort of seeing different rounds, and like undeniably, even maybe those sitting outside of venture think that we pay astronomical prices for the things that we invest in. But absolutely, if you compare the eye-watering valuations that some companies are receiving in the US, we definitely are more price conscious down here. I wouldn't say that is always the case. The deals that make the headlines or people talk about, and whether that's the valuations being paid or the size of the round, $1 billion round for a seed stage company or whatever it is, or we've grown from 0 to $100 million of revenue in 1 month. This is like 0.001% of what's actually going on. We speak to international investors in the US that are just as price conscious as Aussies. Certainly they are in Europe. And so, yes, I think what you'd probably say though is that the spread is wider. So they will go far higher, but the median is probably also a bit higher. But I think they're not, it is important to look beyond the sort of very big headlines. But, it would be untrue to say that there is not an opportunity for startups. It would be untrue to deny that if you were a Series B or C company that's doing really well with a global presence, that you could potentially get a higher valuation out of the US. Andreessen just raised $15 billion.
It's amazing, isn't it?
Your money to spread around.
One good data point on overall value creation in Australia is that Deal Room published that they measure $500 billion Australian dollars of value for the entire tech ecosystem in Australia, and that figure is up 6.5x since 2018 and 2.5x since 2020. So we actually have seen just tremendous growth in our ecosystem. One thing I didn't appreciate until recently was that with Australia is the ecosystem that's only behind India in terms of growth in valuation of the ecosystem. And then I think a lot of people have also seen the chart where we're number one on capital efficiency for every $1 billion USD invested. And part of that is obviously it's hard to raise money in Australia. Founders are very resourceful. So there are very strong underlying trends for the Australian market that give should give a lot of reason to be excited by what Australian founders are coming up with.
So speaking of being resourceful, one of the things I found interesting on one of the slides, value beyond capital matters, but founders' confidence in investors slip. In 2024, 78% of founders said, knowing what I know now about my investors, I would still raise again. But that has slipped to 65%. And investors believing that their investors provide value beyond the capital invested, in 2024, that was 66%. That's slipped to 55%. So either founder expectations are increasing or investors are getting lazy.
Maybe they have the shiny stars of AI that's capturing their attention, right? So I do think there's sadly a cohort of companies where their investors are, have become less interested in the business, sadly, because maybe growth has tapered off. And they are seeing, in terms of new investments, some exceptionally fast-growing AI businesses. And so that is a real challenge. And I mean, at Folklore, we have a very concentrated strategy. We try to invest at pre-seed, seed, and Series A. and work really closely with our founders and ideally invest tens of millions of dollars more over time. So we work really closely with the founders, but I think there are a whole cohort where their founders are just paying less attention than they used to be. And there's no silver bullet to dealing with that. It's just an unfortunate reality, but it's certainly something that I'm seeing more of just day to day.
I assume you guys have the data on which founders from which funds expressing these sentiments. So you know the funds that are actually adding the value.
I think it's a small Queensland fund. Can't remember what they're called. Look, I agree with Albert. I think, look, I've always been more in the camp that there is only so much that your investors can help you with. Like at 5V, we really focus on introducing you to customers, introducing you to executive hires. We're not great at junior hires. We're not good at doing blast outs on LinkedIn to help you find junior marketing staff or sales folks, but we're very good at finding senior executives. We're good at helping you with corporate governance, and we're really focused on trying to help you be introduced to overseas investors. Everything beyond that, I think it's really hard for a investor who is, first of all, managing a lot of portfolio companies in some instances, but second of all, not in the weeds every day, trying to spending every waking hour focused on the problems that you're trying to solve as a company. And so, look, I think it's we know this, it's a meme. VCs being helpful. I think we should all be self-aware enough, and that we shouldn't try and claim that we're going to be a silver bullet to everyone, every founder or every company's problem. But at the same time, I think you need to, as a fund and as an investor, decide where you can help. You're uniquely placed to help, and really focus on those things, and don't overpromise just to win the deal. I think that's where the outcome versus expectation is what causes this sort of data, as opposed to just, if you don't have the expectation due to promises made and things play out that you get called once a quarter for your quarterly update and nothing else, then I think that ironically that number would probably be higher because expectations were set up front.
Related to that, it was just interesting that what investors thought their value was and what the founders thought their value was. There was certainly some discrepancies there, like strong brand and market presence was like 2.5 times more what the investors thought was important, whereas the founders all rated things around, like you say, trustworthiness and track record and that kind of thing. So I think it does boil back down to those more simplistic things over time.
Yeah, and look, favorable deal terms was number one for founders. So let's not, at the end of the day, it's a very long relationship, but there is a transactional element at the front end, and founders, there's probably a stated preference versus revealed preference piece here, which is they are being honest that valuations are super important. Brand is important. Market presence is important. There are a couple of funds here and there are a couple of funds globally that are well established, have a long track record, and it would shock me that they weren't winning deals off the base of that well-deserved brand and presence. So I think there's certainly certain things that I think were interesting in that stat. I mean, like the commitment to diversity and inclusion, lowest for both founders and investor. I don't have a perspective on that, but it's like that is a recurring theme. So I think there is we asked that question intentionally. It's the same question to both investors and founders, because we do think it is interesting that across the board, you've generally got misalignment in terms of what founders really will state to value versus what investors believe. But yeah, there's a lot, and unless we were doing focus groups of founders and investors, I think it'd be hard to really unpick some of the insights.
So one of the, related to exits and liquidity and all of that, there's one of the slides talks about an exit crunch coming, and we have that many companies that need to get an exit in order to get this liquidity machine going. I just wonder if that's actually possible. And then a slide later on talks about actually becoming more PE backed rather than venture backed, and capital going towards that more profitable cash flow producing growth rather than the traditional VC burner rocket growth. So what are your perspectives as investors when you look at this report?
Yeah, so it's an interesting piece that was from Scott from Terram Capital on exits. And I think like the concept of an exit crunch, there's a couple of elements to it. So you've obviously got an ecosystem that, the modern version of the venture ecosystem really started a little over a decade ago. And we did have for the first time in 23, exits started to become more of the part of the conversation for those funds that have been around and been very, very successful, but ultimately had to find an exit for those funds that had gone beyond their 10-year life. So that wave is just building up on the basis that there are more funds. The number of new funds increased over those initial years, and there haven't been exits. And so that's piece number one. I think the other piece that Scott touched on was more traditional businesses. So businesses that are being run by folks that are now reaching retirement age. They maybe don't have children that either want to or should or could take over. And so they too need to find liquidity for their businesses unless they just want to shut the door and throw away the keys. And so there is a huge amount of sort of pent up supply, I guess, which is sort of comes to the next point. And I have a horse in the race because like 5V, is a private equity fund. We have a growth fund. We have a later stage fund. The growth fund was specifically set up to take advantage of some of these scenarios where you've still got these fantastic businesses that have maybe got to $20 or $30 million of revenue, but are now growing at 30 to 40% and may have been around for 10 years. And they've consistently grown at 20 to 40% for the last 5 of those years. There aren't many venture investors that are going to look at that. And up until recently, there haven't been that many private equity investors either. So I think the key takeaway is that there are just more options on the table than just an IPO or a trade sale, where there is this crunch where certain parties do need to exit, but maybe the founder doesn't want to or doesn't need to and enjoys it and can stay on for the ride. And then the other piece is around these secondary funds that have popped up. There aren't many of them, but there are a handful. And those funds are either cherry picking the best opportunities within some of those older funds and trying to buy those, or actually in some instances buying entire tranches of portfolios that are almost a mixed bag of top performers, less good performers, and it becomes a negotiation on price of what they're willing to pay. So yeah, it's a massive theme within the report. We need liquidity. We need to have like the tap needs to be unlocked and we need it to flow, because until that happens, you've got a lot of value locked up and it can't start to recycle through the ecosystem.
Yeah, I just add to that, Chris, that in a prior life, I was very fortunate to be a general partner of a fund with 45 exits. And so we've seen all types of exits, from tiny ones to very, very material ones that are listed on the NASDAQ. And so this need for liquidity is very, very significant. And I mean, you look at some of the funds that have been raised in the last few years, and I mean, it's public, for example, that Lightspeed's return data was released, and they don't have liquidity for their 2018 funds onwards. I know there's funds that are in even earlier vintages in Australia that have no liquidity at all, and they're sitting on, what they think are very good assets, but turning that into cash for the people that backed them a very, very long time ago has been very challenging. So to me, secondaries are very important, and it's one of the reasons that if you look globally, we've seen that secondaries globally are now 3x the value of US IPO proceeds. So it's really grown very materially. And that's not surprising, because the median age in the US in the last 20 years at IPO has gone from 7 years to 14 years for the companies that actually achieve an IPO. The bar is just so high right now to IPO in the US. You really need over 800 million was the average revenue in the last quarter for the 18 or so companies that actually achieved an IPO in the June quarter, which was the last data that I saw. So just very few IPOs, M&A still there, but muted. And so just getting creative on how you can achieve an exit, getting creative as a founder on who can you bring in that will support you in the next leg and really position you for, the next 5-10 years, I think is really, really critical. So I'd say this is one of the largest challenges that Australia's very high-performing VC market faces.
I think that segues well into something you had in there around recognition of the importance of vintage diversification. And, some of your data there around how certain vintages are responsible for returning essentially the majority of returns. Could you just speak to some of your perspectives on those data points?
Yeah, look, so I think it was Max from Advance VC, which is one of these secondary funds that popped up, just talked about this concept of vintage diversity for funds, where, like, put simply, is if you're a professional investor, you should be investing through cycles, and you can't just put pens down because you think things are overheated, or you think you shouldn't just necessarily quadruple down and deploy 5x what you usually would in instances where you think the market is well priced. I think the reality is recent history shows that we all deploy the most capital. We not necessarily the 5 geniuses on this call, but as an asset class, we deployed more capital at the hottest time, and it all blew up shortly thereafter for the majority of the market. And so Max's point is that for funds, deploying capital consistently through the cycle, and yes, sometimes you'll end up paying less or more than what you would, at the year prior, but that's just part of the game. And if you consistently do that, then it should, over time, if you believe that markets will go up and down, if you get to invest in both hot and cooler markets, hopefully you'll also get to exit in both hot and cooler markets. And trying to market time, I don't believe that you should be trying to time the market as it relates to the stock market. And just like dollar cost averaging is recommended for most investors in public markets. And I think, in my view, I share it with Max, that you should be doing the same as a professional investor in venture, and also as an angel. In the angel section of the report, we did see an uptick of general activity of angels versus last year. And an interesting dynamic is that they're actually, the angels that we surveyed are investing smaller amounts but diversifying more, so making more investments, which is actually how you should be building an angel portfolio, not just lobbing in for the one investment a year. And I think the same applies for professional investors as well.
Yeah, I'm fortunate to be an LP in a few funds personally. So in addition to some of the work I do with Folklore, and I'd say, obviously there are a lot of funds in 2020 and 21 that are just going to be very difficult vintages. So even if you correctly picked some great companies, it's just going to take longer to get cash back. I think we will all have very, very gray hair by the time every dollar is returned from that 2021 vintage.
Well, given the grayness of our hair and the fact that Jack has no hair, I don't
Any
really
time
know.
now. I was waiting.
I imagine the hair will regrow.
Yeah, regrow. And so, Chris, I think it's coming up to our 4-year anniversary of our personal relationship, which obviously started with me quite rudely and unfairly attacking you on our humble podcast about pulling crowdfunding out of the report. Are they going back in soon? Where are we at with crowdfunding?
So not included anytime soon. Do you know anyone that's recently made any investments into the platform?
We might know someone.
Potentially bias your perspective on whether or not we should talk about it?
Possibly.
No, look,
It's a good call out. I am now conflicted, and I am a small shareholder, and the only reason why I'm participating is I think actually now people agree with what you were saying all along, and they've got some energy to want to fix it. But yeah, I'm interested in where you're at.
Look, I think that the more sources of capital that are available to startups, the better. What I said 2 or 3 years ago as it related to this asset class is that I saw under prior ownership perhaps or stewardship that there were certain ways that deals were being marketed, information was being disclosed or not being disclosed, incentive alignment being out of whack, that I didn't think that it was being its best self or living up to its potential of what it could be.
Investor communication. There's a lot of things still to be solved.
There's a whole bunch of issues. Look, I won't call them out by name. The 2 people that are now senior at one of those organizations are fantastic. I have a lot of time for them. They have lots of other ways they could be spending their time. They'd be highly demanded, and they are. They're busy people. And so the fact that they're spending their time to try and make that asset class great again, I'm very supportive. And I'm glad that you're betting the farm with your own personal capital as well. Sure, you'll make all the difference.
That's funny. Well, I think this funding report should give a little bit of a shot in the arm. I think it's fair to say the addition of the AI has meant that it got deeper perspectives, and maybe I just haven't read the other reports well in the past, but there seems to be a lot more useful information in here that I think can guide not just founders, but investors as well. Is there any other things that you just want to call out before we wind up?
No, look, I just, a couple of things. Look, we do, both Folklore and myself want to thank the different organisations that make it possible from a commercial standpoint. So we've had Cause and HSBC for many years. We've had EY join as a commercial sponsor this year as well. And all 3 of them provided great content and non-biased content for the report. And then the AIC, QIC and LaunchVic as well. So I want to thank them. And then honestly, like the piece in the report that I drafted at the front of the report was really around some of the observations that I've had around running Cut-Through for the last 5 years and doing this report with Folklore for the last 5 years. And I think I am self-aware enough to know that nothing that we've done is that clever that it would have been successful just with me trying to do it, or just with me and the Folklore team. It really is because people have leaned into collaborating with us. And in many of those circumstances, they're direct competitors of mine during our respective day jobs. So it's a team effort. The report wouldn't be the same without people like yourself, Don, that took the time to do the interview and provide quotes and insights. So I can speak on behalf of Alistair and Albert and the rest of the Folklore team and the Cut-Through guys to just say thanks to everyone in the ecosystem that participated. And we hope you enjoy the report, and there's a lot to be excited about as we roll into 26.
Well, really appreciate having you guys on. We're going to link this report into the show notes. Highly recommend listeners make sure they download it and look forward to the next ones. Just one thing, where did you find that photo of mine out of interest? Because that's a cracker.
Because your photo, like everything about you. So your photo is literally a photo of you.
I'm going to start
You
using
look
that.
like you're going to school dance. You're wearing like a jacket and tie. And I was like, this poor guy, he's going to be the one guy in the VC report, the picture of him wearing a tie. So I
wondered that. So this is
the only person that we had to put your photo into Gemini and switch out your shirt for white t-shirt.
I wondered. Like I've not.
No one else dressed as like they're going to a school dance. Where's the photo?
We've been trying for 4 years to get a better profile pic of Don.
Yeah.
And it was a school dance. It was my wedding.
Yeah, I was going to say, wasn't it your wedding, your first wedding?
No, it was the second actually. But thank you for referencing the vintage
t-shirt.
Yeah. No, that's
Thank you very much, guys.
Thanks, guys.
Thank you so much. Good luck, Seth.